Yo, welcome to another episode of Invest in You. And in this episode, we'll be going over a request from one of y'all. I chatted about EasyProperties, we went into depth, and one of you requested that I go a bit more in depth on the internal rate of return, the capital gains on our EasyProperties properties. So in this video, we'll be doing exactly that. Before I get into the spreadsheet part of things, just a little background on capital gains. Now, obviously, when you buy a property, capital gains is influenced, meaning your property can either grow in value, and yes, it can also decrease in value, which is not ideal. So when we go into these figures and when we go through them, remember, they are all speculative. They are not right and way. Only the fees and stuff like that will be. But when it comes to capital gains or like your internal rate or even inflation, your cost price index, that is all fluctuating and not always certain. So it is very important to remember that these are indicative figures, meaning they are not set in stone. Now, what affects your capital gains of your property? Okay, now imagine, for instance, the property we'll be evaluating today is the Rockefeller one. We'll be looking at that. Now, the Rockefeller is built in Cape Town. It's built in an area that is relatively or very well developed already, although it is built next to a huge new development called the Harbour Arc. Now, this development will indefinitely pull up the value of these properties. Okay, there's also a gym in close proximity, there's school, and it is in the CBD. So all of those things push up the value of your property. Okay, now imagine you had a property that was built in the middle of bloody nowhere, okay, and then a flood comes, and then there's like a whole flood, and there's like a new ocean next to you, or not an ocean, like a dam, okay, and like people can't build there, malls got flooded, like, you know, something happens. Your property value will decrease because now it is not the greatest area to live in, okay. Or if you had to buy a property and then in a year's time, like a coal power plant decides to be erected close by, that will decrease your property value. Okay, so stuff like that affects property value. So when you decide which properties to buy into, make sure, as I said in this video, go look at the area it's in. Go look at what's around it. If it's close to a school, if there's maybe future projects, go look at those things. Okay, so let's get into the spreadsheet. You're going to be looking at the prospectus of any property. Okay, now around about by page 32 or somewhere, you'll see at the top section of this spreadsheet there's a SPV cash flow. Now SPV, all it stands for, it is special purpose vehicle. For the purposes of my channel, I do not like acronyms and big words and stuff, so all you have to know is SPV is just a little company they made to represent your investment or this property. Okay, we're not getting into the nitty-gritty stuff of that. You don't technically need to know. Okay, there are two sections of this cash flow. One is very, very important to you, and the other one just gives you a bit more of an indication of what happens with your money in this SPV or this company. Okay, so the first part is, now, in this scenario, they assume a 10,000 Rand investment from you. So you pay EasyProperties to invest into this company. That is that 10,000 Rand that you see there at year zero. Okay. Then all of these little things in brackets, that is expenses, that is negative value is bad for you. Okay. But it is all fees that are part of you investing into this property. Now, you can go to the bottom of this prospectus where they give you exactly a lot better of a breakdown of the fees that go into this property. Now, this annexure, this is annexure H. This gives you a view of the entire property, and then it also shows you the net profit after taxation, and that is what gets divided to all the shareholders. Okay, but now let's go back to our little version. Okay, first of all, obviously the net income from properties. So that is the rent income that you get from those property. Okay, and then there's all the expenses and the taxation and all those fun, lovely things. Then this 342 year, you see, that is your portion of what is left from the net income from the property. You'll also see that this increases every year. So what they do is here at the bottom in the notes, they'll say that there is gross income or a net income from properties escalates annually at a CPI of 4.5. CPI is just your cost price index, another fancy word for inflation. Okay, so they increase the price of rent to match inflation. So that obviously we know inflation is time value of money. As time goes on, your money value gets worse. Hence why we love cryptocurrencies. Okay, but anyways, let me not get into that. So inflation bad, makes your money less worth. Okay, so we have to account for that. That's why rent goes up, so that you can beat it. Okay, so then once that is now all the expenses of the property, so from this 342, EasyProperties has to keep a section out for maintenance and other stuff. They've now already taken their cut with their property management fee. Okay, so that 34 Rand is then what they keep behind for maintenance. That 308 Rand, that is the cash dollar dividends that gets paid to you. Okay, so then they do that for every year, and in this assumptions, well, in all of their companies that they build. So what EasyProperties does is, when you invest into the IPO, you buy into a 5 or 7 year contract. And what they do is at the 5 or 7 year, they are going to sell that property and pay the proceeds back to you, to all their investors. Now, what they did say is they don't have to sell at 5 or 7. So what can happen is when they reach 5 years, they see the property market is doing so well that they'll rather extend it another 2 years and only sell after the 7 years because the property market is doing so well. Now, this investor IRR calculation is what you want to look at. Okay, so you've paid your 10,000 Rand, that 100 Rand is the brokerage fee when you invested. That's the same as buying an ETF, your total expense ratio. Okay, then every year there is a platform fee on EasyProperties, which is either 60 basis points or 0.6% of your investment. Okay, and you don't have to worry about paying that. Okay, you only pay this when you invest into a property, and then they just deduct it from the dividends they pay out to you. Okay, so that 308 is the dividends you received, and then you get your investor net cash flow here at the bottom, and that happens every single year. Then here in the end, you'll see they give dividends received from property disposal is 15,172. So that means they've sold the property, they've divided the proceeds up, taken all the expenses and the cut off, they've taken off capital gains tax, all those fun and lovely things, and then gave you the money, meaning you know. But now you want to know if this is a good investment, because this is the point of this. They may try and make you understand that if this is a good investment and what you need to look at. So before we get to the crux of it, just go down to the note here. There you can see all the assumptions they make. So they assume that a capital growth of the units of 5% per annum. So that means that they think the property value will increase by 5% per annum. They give you the CPI, they tell you what this expected rent is. And then again, if you go down to an extra H, they'll tell you how much percentage they assume of your total property life will be unoccupied, meaning no one will live there not paying rent. In this case, they assume 5%. Yeah, so there's a lot of things that you need to consider and a lot of assumptions, meaning, hence again, this can change the final outcome of what your return is. This investor IRR, this is the thing you want to look at, but it is not the thing you want to only look at. So I really wish they gave you the return on investment, because I like to compare IRR and return on investment. Okay, so now, what is IRR? It is your internal rate of return. Okay, and this is the formula for it. Now, the internal rate of return is normally what companies and big investment bankers and all of them want to know. What it shows you, it is what growth will you make annually, okay, to break even at the end of your view period. So after these 5 years, what is your annual growth you're going to achieve to have a net present value, meaning today's value, okay, to have zero again, meaning you've accounted for inflation, expenses, and all those lovely things, and you made it back. Okay, so that is that 10.5%. Now, You want to know if you actually make money. You don't just want to be like, okay, well, I just gave them money and I got the exact same amount back, because that is not ideal for our case, okay? Now, you want to know the return on investment, meaning what do you make profit-wise on your investment? So, a little Excel calculation, you're just going to go put in all those cash flows, and Excel makes it really easy for you. You can literally just go calculate all of those. So your return on investment in this case, if it follows exactly this, will be 31% of your initial 10,000 Rand invested. Okay, so that means you will make a profit of about 3,117 Rand. The reason for that is those lovely dividends that get paid to you, that is the crux, and also the sale at the end. So your property value grew, they sold it for more than what you initially bought it for, meaning you made some cash dollar. Okay, so that's why it is very important to compare the two. Now, I can go into span depths of what your IRR should be compared to your WACC rate, your project IRR, your hurdle rate, all those lovely things. But all you need to know, okay, when you look at your IRR, a bigger IRR is better. Okay, because it means you make more annually and your chances of making a bigger return on investment is better. But it is always a good idea to just go do a little calculation and see what can you expect to return from that property. Okay, because you don't want to be losing out span cash thinking you're making money. But as a general rule of thumb, when you see an IRR of 10% and more, that normally means it's probably a good property investment. Okay, and that is pretty much how to look at capital gains on these EasyProperties prospectus. So I've said a lot and I've just rambled Excel spreadsheets. So I am an investor that doesn't like to just stick to spreadsheets, because I feel like that's where you miss it. So always look at the other things. As I said, the capital gains, it's very good and well to understand how a spreadsheet can make you understand the capital gains. But if you don't understand the situation your property is in, that you invested, you won't know if that capital gains is going to be missed, if it's a lie, or if it's close. Okay. And these things are obviously all audited and independently evaluated, so they are usually rather close. But things do change. And a prime example of how EasyProperties just makes our lives at the moment so much better, and why I'm so bullish on EasyProperties is if you go look at the trading statement that was released recently by a very big investment property holding company, okay, Growthpoint, they showed a 20% or almost 20% vacancy rate in their offices. Okay, so when you invest into Growthpoint, you get all their properties, okay, whether you like them or not. The nice thing with EasyProperties is you get to choose which properties you want to invest in, okay? And now it's so nice because EasyProperties at the current stage is mostly residential properties, meaning people will working from home, meaning they need places to stay in. So those properties are not being left vacant. So it is very important, and that's just why I love EasyProperties, is to look at these things, and you have a lot more control and you learn a lot more when it comes to stuff like this. Where if you just bought into a REIT, a real estate investment trust, you might have just not focused, gone over your head, and you might have just missed it. Okay, so this is why I love EasyProperties. Okay, so enough of me just loving EasyProperties. I hope this helped. If there's any more questions, hit them, throw them at me. I love it. It makes my life easier to understand what you guys want to learn, because we're learning together. It's a learning process. But yeah, in any case, thanks for watching. Hit like, subscribe, and see you guys next time.